Every dollar bill in your wallet is a promise, but a promise made long ago was broken on one shocking Sunday in August. It was the moment the world's most powerful economy, the United States, admitted it had run out of gold. This isn't just history, it's the secret origin story of inflation and national debt. It's the day the dollar stopped being backed by gold and started being backed by, well, nothing. And it all leads back to 3 days of secret meetings at Camp David in 1971. To understand how the global financial system reached that breaking point, you need to go back nearly 3 decades earlier to the ashes of World War II. The world's economies were in ruins. Europe's cities were bombed, trade routes shattered, and currencies worthless. Leaders from 44 nations gathered at a remote resort in Bretton Woods, New Hampshire, to design a system that would prevent another Great Depression. What they wanted was simple: stability. The plan they agreed on was revolutionary for its time. Every major currency would be tied to the U.S. dollar, and the dollar itself would be tied to gold at a fixed rate of $35 an ounce. The United States held over 2/3 of the world's gold reserves, and its economy had survived the war intact, so the world accepted this arrangement. The dollar became as good as gold. Literally, for 2 decades it worked. The system brought order to a chaotic world. International trade flourished, confidence returned, and the U.S. dollar became the lifeblood of global commerce. It was an era many economists now call the golden age of capitalism, when money meant something and fiscal discipline was a virtue. But beneath that calm surface, cracks were forming. The entire Bretton Woods system relied on trust that the United States would never print more dollars than it could back with gold in Fort Knox. For years, that faith held. But as the 1950s turned into the 1960s, America found itself fighting 2 wars at once. One was the Vietnam War, a conflict that consumed billions of dollars every month. The other was a domestic war against poverty, inequality, and unrest. The Great Society programs launched by President Lyndon Johnson. Economists later called it the policy of guns and butter. Washington wanted to finance both the battlefield and the home front without raising taxes, and the easiest way to do that was to print more dollars. By the mid-1960s, the United States was issuing nearly 4 times more dollars than it had gold to back them up. To most Americans, nothing seemed wrong. Prices were still stable, wages were rising, and confidence in the dollar was unshaken. But overseas, central bankers were doing the math, and they didn't like what they saw. Among them was Charles de Gaulle, the proud and defiant president of France. He had never trusted the dollar's supremacy and saw the Bretton Woods system as a financial weapon that kept Europe under American control. In 1965, de Gaulle publicly called the dollar America's exorbitant privilege and began converting France's dollar reserves into gold. Ships left French ports carrying pallets of paper money bound for New York and returned with gleaming bars from Fort Knox. Other nations quietly followed France's example. Germany, Japan, and Switzerland all began to exchange their dollar holdings for gold. It was a slow-motion bank run against the world's most powerful country. Inside Washington, panic spread. Economists warned that if every nation demanded gold at once, Fort Knox would be emptied within months. By 1971, the pressure was unbearable. The U.S. had lost tens of billions in gold reserves, inflation was creeping higher, and confidence in the dollar was collapsing. On a single day in early August, investors converted over $1 billion into German marks. It was a direct vote of no confidence in America's promise. The once unquestioned global reserve currency was now on the verge of implosion. President Richard Nixon, known for his fierce political instincts, understood what was at stake: A full-blown currency crisis could destroy not only America's credibility, but his presidency itself. He turned to his Treasury Secretary, John Connally, a brash Texan and former governor with a reputation for bluntness. Connally summarized the situation in a single devastating line: "We are running out of gold, Mr. President." The options on the table were grim. Option 1, admit defeat by raising the official price of gold, effectively devaluing the dollar. Option 2, tighten spending and risk plunging the U.S. into a recession. Or Option 3, break the system entirely. Close the gold window, refuse redemption, and declare the dollar a fiat currency. It was economic heresy. On Friday, August 13, 1971, Nixon summoned his top economic team to the secluded presidential retreat at Camp David. For 3 days, behind closed doors and under conditions of total secrecy, they debated the future of the world economy. Present were heavyweights like Federal Reserve Chairman Arthur Burns, Treasury Secretary Connally, and future Fed Chairman Paul Volcker. They argued over the risks. If they closed the gold window, would the dollar collapse? Would America lose its leadership role? Or would it finally free the U.S. from the golden leash that was strangling its growth? Connally, ever confident, told his counterparts that foreign governments would have no choice but to accept whatever decision America made. The dollar is our currency, but it's your problem. That single sentence captured the arrogance and the reality of American financial dominance. By Sunday, the decision was made. They would suspend the convertibility of the dollar into gold, officially calling it a temporary measure to calm markets. They would also freeze wages and prices for 90 days to slow inflation and impose a 10% surcharge on imports to protect U.S. industry. It was a 3-part economic shock designed to stop the bleeding and buy time. What happened next would change the course of financial history forever. On Sunday evening, August 15, 1971, while global markets were closed and the world was preparing for another quiet trading week, President Nixon appeared on national television. The broadcast was calm, almost casual. Sitting behind his desk in the Oval Office, Nixon addressed millions of Americans who had no idea that the entire global financial system was about to change forever. With his usual confidence, he began, "I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets." He called it a temporary measure, one designed to protect the American worker and stabilize the economy. But everyone in that Camp David room knew the truth. The suspension would never be lifted. The gold window was closed for good. For the first time in modern history, the U.S. dollar was no longer tied to a physical commodity. The Bretton Woods system, built on the promise of gold convertibility, was dead. Nixon had just delivered what economists later called the Nixon Shock, a financial earthquake that permanently changed the value of money itself. Around the world, the reaction was immediate. Finance ministers were caught off guard, central bankers were furious, and European newspapers labeled it an act of financial war. The United States had unilaterally rewritten the rules of the global economy on a Sunday night when no one could fight back. When the markets reopened on Monday morning, the dollar tumbled. Currencies that had once been pegged to it began to float freely for the first time. Gold, suddenly freed from its $35 shackle, surged in value. Within months, the price doubled, and within a decade, it would rise more than 20-fold. The age of fixed exchange rates was over. In the short term, Nixon's bold gamble appeared to work. The U.S. stock market rallied, exports increased, and a sense of national pride returned. Connally toured Europe to reassure nervous allies, delivering his famous line once again. The dollar may be our currency, but it's your problem. Many believed the crisis had been averted, but underneath that temporary calm, the foundation of global finance had shifted permanently. Without the discipline of gold, governments were free to print money at will. Central banks could now expand credit without constraint, and politicians discovered a dangerous new power, the ability to spend without saving, to promise without paying. The old world, where overspending led to a loss of gold reserves, was gone. In 1971, the U.S. national debt stood at roughly $400 billion, a figure considered enormous at the time. But once the dollar became a purely fiat currency, debt was no longer a physical limitation. It was just numbers on a balance sheet. By the 1980s, borrowing became normal. By the 1990s, it became necessary. And by the 2000s, it became a way of life. Today, that number has exploded beyond comprehension, over $34 trillion and climbing by the second. Every dollar of that debt is built on the foundation laid in 1971, when America disconnected its currency from gold and tied it instead to nothing but trust. But what did this mean for ordinary people, for the worker, the saver, the retiree? The consequences would unfold slowly, almost invisibly, year by year. Before 1971, the value of the dollar was remarkably stable. Prices for food, homes, and education changed little from one generation to the next. After 1971, that stability vanished. Inflation became a constant background hum, eroding the purchasing power of every paycheck. A dollar that once bought a gallon of gasoline in 1971 buys only a fraction of it today. The same $1 from that era now has the purchasing power of nearly $8. That hidden tax, inflation, affects everyone, yet few understand its true origin. It is not simply bad policy or greed, it is the inevitable outcome of a system where money can be created without limit. Under the old gold standard, if a government spent too much or ran large deficits, other nations could demand their gold back. That discipline forced leaders to live within their means. But after Nixon's announcement, that check on power disappeared. The United States could issue debt endlessly, confident that other countries would continue buying treasury bonds and holding dollars as reserves. This new system, sometimes called the dollar standard, replaced gold with faith. Nations began accumulating U.S. debt instead of gold bars. The entire planet started running on confidence, not metal. And as long as people believed in the dollar, the illusion held. The 1970s became a turbulent decade of adjustment. Inflation soared into double digits, oil prices quadrupled, and public trust in the government plummeted. The temporary suspension of gold convertibility soon proved permanent. The old anchor of monetary discipline was gone, and with it, the certainty that money would hold its value over time. By the early 1980s, the U.S. Federal Reserve under Paul Volcker was forced to raise interest rates to nearly 20% to crush inflation. It worked, but at the cost of a brutal recession. Economists began to realize that the financial chaos of the 1970s was not a coincidence. It was the inevitable hangover of a world that had just lost its golden foundation. Over the next half-century, the consequences multiplied. Debt became the engine of growth. Every economic slowdown was met with lower interest rates and more credit. Governments borrowed to stimulate, corporations borrowed to expand, and consumers borrowed to survive. It created decades of prosperity, but also built a mountain of obligation that can never truly be repaid. The stock market soared, housing prices exploded, and the gap between the rich and poor widened dramatically. Assets tied to debt, like real estate and equities, rose in value while wages failed to keep up. For the first time, simply holding cash meant guaranteed loss. The dollar had transformed from a store of value into a tool of policy. And yet, the vast majority of people never realized it began on that quiet August evening in 1971. They never saw the invisible chain reaction that turned governments into borrowers and citizens into debtors. The Nixon shock didn't cause a sudden crash. It created a slow-motion decay, a world where every generation inherits money worth less than the one before it. Today, central banks print trillions of dollars in the push of a button. Entire economies depend on it. The global system that emerged from the ashes of Bretton Woods has become a financial casino where the chips are not backed by gold or silver, but by collective belief. And belief once lost is impossible to replace. The legacy of 1971 lives in every inflation report, every interest rate hike, and every debate over digital currencies and cryptocurrencies. When people discuss the future of money, whether in gold, Bitcoin, or central bank digital currencies, they are really asking the same question that Nixon faced more than 50 years ago. What gives money its value? That question still has no clear answer. Because the truth is this: the crisis never ended. It simply evolved. What began as a temporary measure has defined an entire era. The promise that every dollar once carried, a promise of real value, of convertibility, of discipline, died that night. And while gold no longer anchors the system, the shadow of its loss still haunts it. Every financial bubble, every crash, every wave of inflation traces its lineage back to that single decision: the day the dollar lost its golden soul. So the next time you hold a dollar bill, remember, it is backed by no metal or reserves. It is backed by confidence, and confidence alone. The question that remains isn't when the system will break, but how long people will keep believing in it. Because the crisis is not coming. It has been here for over 50 years. If you want to understand the modern debate over money, from gold to Bitcoin to the rise of central bank digital currencies, you have to start with the moment everything changed: the day gold died.